What's up, traders? Welcome to chapter number 2. In this chapter, we're going to focus solely on divergence. We're going to put the A1 aside for a few minutes and talk about what divergence is really telling us in the market. Before we dive into this whole chapter and before we get into the D1 and D2 systems, we need to lay a foundation of understanding when it comes to divergence. And I think the best way for us to get that foundation, to really put it down, is to just go over some of the most common questions I get from beginners and from advanced traders on the topic of divergence. The most common question is always going to be, what is divergence? The way that I want you to understand it for our group, for us going forward, is that it's a disagreement between price action and an indicator. In our case, the indicator is a 21-period RSI. Ours is attached to the TDI. You guys know that already. But for us, please keep in mind that the divergence that we're talking about, the divergence that we're looking for every day, is a disagreement between price action and an indicator. Why is that disagreement important? Well, because price will lie to you. For whatever reason, the indicator will not. And what I mean by that is you've seen it, I'm sure. If you're watching this course, you've been in the markets for a good enough time here where you've probably seen where price will move almost erratically in one direction before then continuing in what seemed like the direction it should have been going. Price will do that, whether it's because of poor liquidity, whether it's because of order grabs, whatever blame you want to put on it, that's fine. We know from the back testing that price will lie, the indicator will not. Another important factor to take in when talking about divergence is that you can use divergence to not only spot the end of a pullback before it continues an overall trend, but you can also use divergence to spot a possible reversal area. Divergence at its ground level is telling us that the market is changing. And it's important to use the word changing because very often you're going to grasp this divergence like most traders do, and you're going to be seeing it more often now after this course than ever before. And what's going to happen is you're going to say, Austin, there's divergence on top. This could reverse off the high. Right, it could, but you have to remember me saying this right now, this far into the course. What are we, about an hour in here? Remember me telling you that divergence does not mean reversal. Divergence means change. That means that the market does not have to fall off that high just because you can spot divergence at the top. It means that that market might be chopping. What it really means is that you probably should be cautious trading long into that divergence on top. Now, we're going to get into that a little bit more with examples as we go deeper, but understand divergence means the market is changing. The most important levels that you have to pay attention for are right in front of your face here. The Asian session high or low, yesterday's high or low, the 50, 200, and 800 EMAs, because we're going to find pullbacks off these levels. And the other important level to keep in mind is ADR Max. This is a point, a lot of people get this confused. ADR Max means average daily range is maxed out. What that means is if Euro USD's ADR, its average daily range is 65 pips. Today, it's already moved 65 pips. That could be an area where if you find divergence at that ADR max point, we might see a retracement. Since it maxed out its ADR, it might need to pull back in whatever direction it needs to retrace that move within the average daily range. So write these levels down. They're going to come into play when we get into the markups later in chapter 3 and chapter 4. But remember these 4 bullets as your 4 most important, most key levels that you can ever use for identifying divergence. So what is divergence really telling us? If you're in a trade and divergence presents against us, we may need to consider an exit. And what I mean by that is if you're in a trade and divergence presents on top and you're going long, you might want to second guess if you should hold that long trade now that divergence is presenting, because why? What did I just tell you divergence tells us? As soon as you think that, you have to say to yourself, divergence means change. It's important to keep that in mind. So you can use divergence if it's presenting against you to say, hey, you're in the trade, you're up in profit, but divergence is building. Maybe you take your exit here. That's a point where maybe we're going to go over this. We go to the higher time frames to see what the true direction of trend is to determine if we should pull the trade or not. But we definitely want to understand that divergence can present against our A1 trade and signal that change is coming. If we're looking to re-enter a trade into divergence, we have to take note of that because it's going to be a less probable trade because divergence is present. It's very important to keep that in mind. So again, using the long example, if you were looking to go long Euro USD and this is your first trade of the day, but you see divergence on top from the previous high set earlier that day, you might want to pull yourself back from taking that position because you know the divergence on top could signal the market is changing and you might not get a retest of that high because the divergence is present. Now, if what I just said is a little bit too deep for you, we're going to go over this in hundreds of markups. So just follow along here with me, stay with me, maybe rewind me. I know I talk fast, but try to keep yourself here as I'm giving you these visual examples. It's really important, like I said already, I'm stressing this a lot, to not assume reversal just because divergence is present. It's a warning flag that change is coming. And you're going to be able to find these divergence signals in trend and counter trend. That's going to be our D1 in trend and our D2 counter trend. Now, here's an example of using divergence on, happens to be Euro USD, to say, let me not go long into this divergence on top because it could prevent me from moving higher because it decreases the probability of the longs working out. So in this example, if you were looking to go long here off the 50 EMA, TDIs in the buy zone, EMAs are in an uptrend, if you were looking to go long here, it would make sense. But if you're really good at analysis, you can see the divergence. If you don't know how I drew these purple lines, we're going to go over that in a second. But you can see divergence, RSI is falling, price action is rising, and that should keep you out because we're going to trust the indicator, not price action. Even as price is rising, making higher highs and higher lows, we know we don't want to go long here because that divergence is present. Even more, look at those pins right to the divergence line with a falling RSI. That falling RSI is what we want to trust. Not necessarily here in this example to trade it short, but to say, hey, this is not a great time to be going long. So just to go back to the previous slide, understand that divergence can be used in a situation like this to tell you, hey, if I'm looking to go long here and it creates divergence and I am long and I'm in profit, that's a time to potentially take that trade because as you can see, it'll fall away from you. And it can also be used to tell you, hey, if you're looking to go long here, because divergence is present earlier in the day, we want to pull off and find a better trade. So let's talk about how we use divergence. Now, there's two ways to identify divergence, bullish and bearish. Before we talk about the bullish and bearish divergence, I'm going to show you that in the next slide. I want you to understand my way of looking at divergence. No one else talks about it this way. I look at it as in trend, which we call our D1 entry. This is divergence that we find at significant levels that tells us when a pullback is done and trend is ready to continue. That's the first way we'll use divergence to find trades. The second way is our counter trend entry, which is the D2. This is divergence that you see at the extremes, and this is telling us that a potential change is about to occur, either chop or a reversal of some degree. It's important to distinguish the differences between these two. Your D1 entries are going to come when the L50 and the EMAs and all the higher time frames agree with the direction of trend. Your D2 is going to be a less probable trade, and it's going to present at a different point in the movement of that market. It's going to present maybe at overbought, or maybe it's going to present at ADR Max or at the high of day, off those significant levels, which would then signal a reversal. So to define bullish and bearish divergence a little bit deeper before we break down the D1 and D2 in detail, I want you to use these visual examples to keep maybe like as reference points. Maybe screenshot this and print it out if you need to. Bullish divergence is defined as price action making lower lows and the RSI, the indicator, making higher lows. So here, the RSI is rising, price action is falling. That's a signal to us that the market could be changing. After the big drop the day before, the market could be changing, and it does. It rises, as you can see, into the next day. Now compare that to bearish divergence. This is when price action is making higher highs and the RSI is making lower highs. So just like you see in front of you on EuroCAD, price is moving higher, but the RSI is actually moving lower. And that signals to us that something is going to change. Look at how price just chops its way up and then falls off that high. This is easy to spot when you can identify divergence. People will get caught going long here and because they don't know how to identify divergence. And that's what after this course, you're never going to do again. You're never going to try to go long here with divergence present. Instead, you're going to either look for shorts on a D2 reversal off the high, right? Or you're going to wait for a better position, a better price to go long in the direction if that's the higher time frame trend. So let me explain that a little bit more. Where do we draw it in an uptrend? I want to explain this a little bit more. Like I just said, with the L50 in the buy zone and the EMAs being long biased, bullish divergence is going to present off an EMA or significant level in the direction of overall trend, which in this situation is up. So that's going to be your bullish divergence, meaning your RSI is rising, price action is falling. You're at a significant level in an overall uptrend. And that's how you know that that's a good position to be looking for longs. And in this situation, You're trusting the RSI direction being bullish, not the price action being bearish. That's what the bullish divergence is. Now, like I just said, this is drawn on the bottom of price action and the bottom of the RSI because you're looking for it to move higher. You're looking for that RSI to show rise, the price action to show drop, and you're going to trust the direction of the RSI with the D1 entry signal I'm going to show you in the next chapter. Like I just said, this is a D1 entry in direction of overall trend. Compare this to bearish divergence, which would present at a significant level, overbought, oversold, maybe maxed out ADR, going counter trend. So if you're in an uptrend, you're going to look for bearish divergence, which means a falling RSI and rising price action. You're going to look for that at the extremes, at the high, at the low. You're going to, just at the high because you're in an uptrend. You're going to be looking to almost call the top. This is the D2 reversal off the top. Maybe you're looking that way because you see on the higher time frames that it's bearish overall. Maybe on the higher time frames you're at a significant level, and that's why you could justify taking that short entry in reverse, the bearish divergence telling you to take it short in reverse to the uptrend. Now, again, I know I'm throwing a lot of words at you guys. I know I'm talking fast, but I want to get through this. I want you to write it down, and then we can get into the markups in the next chapter. So to review this slide, understand the EMAs and the L50 being in a perfect uptrend. Your bullish divergence would present off a significant level on the bottom. You would draw this on the bottom of the RSI, it'd be rising, and your price action on the bottom with your purple line or whatever color line, that would be falling. Compare that to bearish divergence, which would signal off a significant level that you could be reversing and coming back down lower. A D2 will present at the top of an uptrend, and you can use higher time frames, of course, to then confirm that if you're going to be able to hold that. But from the get-go, understand that that divergence will come off the top, which means that the trend lines will be drawn on the top as well. It'll be drawn on the top of your TDI, and it'll be drawn on the top of your price action. That's your bearish divergence. RSI is falling, price action is rising, coming off the top. Now, how do we draw this? Where do we draw this in a downtrend? L50 in the sell zone, EMAs are short biased. Your bearish divergence is going to present off a significant EMA in the direction, it's going to come down, of that overall trend. This is going to be drawn on the top of the RSI and on top of the price action. This is a D1 entry used to get into the trade in the direction of overall trend. And again, compare this to bullish divergence, which would present at an extreme and off a key level. And this is going to be known as our D2 entry. This is drawn on the bottom of price action and the bottom of the RSI, showing you a rising RSI calling, in theory, air quotes around calling, the bottom of your downtrend. And you're going to be able to do that and call that by using the higher time frames like I'm going to show you in chapter 3. So again, to review this slide, now we're talking about a downtrend. Bearish divergence is going to present on top of the RSI and on top of the price action. Bearish divergence telling you we're moving down, bearish in the direction of the overall trend. In inverse to that, we have the bullish divergence that presents off an extreme, signaling the bottom, using the D2 entry to find the bottom. This is going to be drawn on the bottom of the RSI and the bottom of price actions. That's your D1 and your D2 in a downtrend.